What's up, Banter fam? Welcome back to the show. I'm your host, Miles, and in today's show, I want to be talking about the FTX contagion. Have a look at how deep this contagion could actually potentially run, what the potential ramifications for crypto could be down the line, and answer the ultimate question that a lot of you are thinking right now. Is this it? Is the contagion over, or could there be more fire to spread? I'll be answering that question in today's video. It's going to be a massive show, so make sure you smash the like button, and let's get straight into the show. So the question I want to answer today is, how far will the FTX contagion spread? And in order to do that, we really need to cover the different market sectors that contagion actually affects. Now, in this thread, I broke down the 5 major market sectors that contagion does affect in crypto, from market makers to funds to retail traders to institutional traders and more. So let's get straight into the show without further ado. Most of you already know what happened to FTX. I don't really need to explain what happened to you guys again. Essentially, just as a TLDR, they did officially file for bankruptcy. Obviously, Sam was extremely over leveraged and reckless, and was over leveraged in terms of his own FTT token, which he was borrowing against itself. And it was just an entire mess that all kind of came to the forefront today when they did release that court filing. One of the findings we saw was Sam even loaned $3 billion worth of assets to himself and his own entity, which is absolutely crazy. The fraud just continues to go deeper and deeper and deeper. But what also goes deeper is the effect it's had on crypto as a whole. So the first sector I want to talk about that this whole contagion is starting to affect is obviously the exchanges. So I want to take a top to bottom look at how contagion actually affects different market sectors in today's video. And when we start at the top, the very first thing and the most obvious thing that this FTX situation has affected is the exchange market. So the first thing I want to note is that there have been exchanges that have announced that they have exposure to FTX, like Kraken, Coinbase, Crypto.com. But the amount of exposure they have is pretty minimal, right? They're like $15 million for Coinbase isn't a lot of money. $10 million for Crypto.com is not a lot of money. However, I think what is more worrying in terms of exchanges are the exchanges that haven't clarified their exposure. Because if you're an exchange and you haven't come out and said whether you are or aren't exposed to FTX or not, that's just a bad sign in my opinion. And that's just a red flag that potentially we could see more exchanges go under in the near future. We have to remember that there are many vulnerable exchanges right now, because essentially what has happened is there's been a shift away from CeFi's. Kind of the trust in CeFi has been eroded recently. A lot of people have headed away from the CeFi exchanges towards DeFi exchanges. And what this has meant is that we've seen a significant amount of outflows from the centralized finance market. When you think about what happens when there's outflows, that means people are actively withdrawing their funds off exchanges. So a lot of exchanges that don't have an adequate amount of liquidity to cover could end up being essentially bank run and end up halting withdrawals like FTX had to in the end. So the fact that there are just so many exchanges in crypto and the demand for these exchanges is now diminishing leads me to the conclusion that I don't think the contagion is over when we consider the first sector of exchanges. For example, we saw $898 million worth of Bitcoin actually move off Gate.io in just an hour yesterday. And then we've also seen many other exchanges seemingly have some issues. So Crypto.com, obviously, they've come out, they've said it's going to be okay. However, there was a significant spike in outflows. And this is not just a trend across exchanges like Crypto.com and Gate, it's across the entirety of the exchange space in general. Even Binance did see, although they saw a lot of inflows on that first day, they also saw a lot of outflows as well. So I think the most important thing above and beyond right now is that we have an industry standard for offering proof of reserve. So the problem is, in the past, exchanges, they weren't really required, or the public didn't really want or demand that they actually introduce their proof of reserve systems. Whereas now I think it's going to become the industry standard that exchanges do offer proof of reserves. And not just proof of reserves, because that's kind of a misconception that you can kind of offer proof of reserves and everything's okay, but also proof of liabilities, which I believe are even more essential, or essentially proof of reserve figures are an act. So I do believe that proof of liabilities, so the collateral that a certain exchange has, the outstanding loans an exchange has, and the liabilities an exchange has, becomes very, very important in my opinion. And that's where I see the future of exchanges going forward. It has to be more transparent. Unfortunately, though, there probably will be other exchanges caught in the wreckage as they basically can't offer transparency without exposing themselves, which is definitely something that can happen. The second sector that I want to talk about, so as I said, we're taking a top to bottom approach on looking at how contagion spreads. So obviously first is exchanges, Second is market makers, because market makers, they're the guys providing liquidity to cryptocurrency markets, and they're the ones that ensure there's sufficient liquidity for the order books to process orders. So if the market makers go down, you experience liquidity issues, which obviously impacts your ability to buy and sell tokens. Illiquidity is a major issue in crypto. It can result in funds and institutional investors not being able to sell assets when they want to sell assets, and this can result in massive price spikes on both to the upward side and the downward side, which can affect liquidation prices as well. So thin liquidity is not something that we want in crypto, but when you do have market makers going down, that does create a little bit of an issue, as the inability to sell an asset can drive its market price down, as it renders the market price indecipherable. So I do think this affects centralized exchanges, of course, but it also affects DeFi exchanges as well, as many protocols do rely on price data and oracles from CeFi. There's actually a trend on DEXs right now, and this is kind of why I don't believe this whole let's just move to DEXs and everything is fun and dandy narrative is really true, because you do have a lot of decentralized exchanges which do still rely on the liquidity of centralized exchanges and also rely on the price discovery of centralized exchanges to dictate price movement on DEXs as well. So the thing is, low liquidity does have an impact across the entire ecosystem, not just CeFi, but also DeFi. And that's something that we've really got to keep our eye on, because the way contagion would spread with market makers is it might affect the main two market makers, which are providing liquidity to exchanges. And then that does have trickle-down effects. So one of the market makers we saw go down was obviously Alameda. They were one of the biggest market makers in crypto. They were market making for many, many different tokens. Obviously, Solana being one of them, Sarah being one of them, but then also across many other tokens as well. And then another big market maker, Jump Crypto, is one that has been under the spotlight this week, as there's been rumors that they're going to be winding down operations after suffering massive losses. Now, if this was true, it would be massive news and it would have huge ramifications for crypto. So obviously that would be a very, very bad thing for the market. However, they did come out and they said that Jump Crypto is not shutting down. We believe we're one of the most well-capitalized and liquid firms in crypto, and we're still actively investing and trading. So we can dispel those rumors for now. The only thing that I'll say about this is that when there's smoke, there's often fire in crypto. And it wouldn't be the first time that a company came out and said they weren't experiencing issues and then ended up experiencing issues. And I'm not alluding that Jump Crypto is in this basket. In fact, I would 99% bet on the fact they're probably fine. But you always have to tread with caution in this space, because there has been many, many occasions where the rumors ended up not being rumors, which is a huge issue. Now, I actually did some digging today, and I found some very interesting stats about market makers. What TechCrunch actually did is they created a Telegram group, and they added all the biggest market makers in crypto to this Telegram group, and then they added up, or they did a tally, essentially via a poll of how much market makers had lost during the FTX saga. And they found that 66% of market makers lost less than $25 million, 7% lost between 25 million and 50 million, 6% lost between 50 and 100 million, and 1% lost between 100 million and 500 million. Now, this is a lot of money in this category, but obviously only 1% of the market makers that they surveyed answered as 1%. But maybe the statistic that's the most surprising out of this is that 20% of market makers declined to comment. And usually, just put yourself in the perspective of a market maker. If you did lose $100 million in FTX and you didn't want to dox yourself or expose yourself, then you probably would decline to comment, wouldn't you? So maybe potentially the contagion lies a little bit deeper than we think in this case. A lot of market makers did operate via FTX. A source close to the matter said you couldn't have a credible market making business if you weren't on that platform. So it's just crazy how intertwined FTX was with the entire industry. But that is the number two sector that we have to look at when determining how deep this contagion could run, and it is the market makers. Number three is the funds. And this is where we have seen the most damage probably done over the last week or so, because when funds go down, this is a major issue, because if we think about who are the largest holders of tokens in this market, it is usually the funds and the crypto VCs. They're the ones that get in on the seed rounds. They're the ones that get those initial allocations. And they're also the ones with the most available capital to buy quite heavily into investments that they have conviction in. So the fact that the funds and the VCs have a lot of exposure to the market via a variety of tokens means that if something happens to a particular fund, this can put sell pressure on certain tokens. And many of the big funds did have FTX exposure. And of course, this can put pressure on a variety of tokens. I just kind of want to run through some of the main ones that have collapsed and then have a look at some of the other ones that are looking shaky. Sino Global, they were managing $300 million of assets in January. They put out a letter confirming a mid-seven-figure exposure to FTX. They said the events over the past week had been shocking and saddening. Like many of you, we trusted FTX to be a good actor committed to pushing the industry forward. We deeply regret that misplaced trust. So they obviously did lose quite a lot of money. They say mid-seven figures. We can speculate what we want on that, but obviously that has affected them as well. Pantera Global came out and said that they had lost 3% of their assets under management in FTX. 3% isn't a big amount, although we're talking very small margins in crypto these days. The difference between a 3 and a 4% loss in crypto can be potentially massive given the fragility of the market. And I'm not alluding to anything being wrong with Pantera once again. I'm just saying that it's never good when you have an exchange or a VC or a hedge fund in this case that has a significant percentage of their portfolio inhibited by an event like the FTX event. So Pantera was one of the other ones that lost money, although admittedly 3% is still not a whole lot, because you compare that to different companies like Sequoia Capital. They lost $150 million in their global growth fund and $63.5 million in their SCGE fund, and it just gets worse and worse as we go down the list. Some funds like Gallo Capital, they're the ones that shorted Luna and made massive profits off the UST shorting. That's how they became very famous. They actually had 50% of their assets stuck on FTX. Super saddening for the Gallo Capital guys. They can't access essentially half of their fund now. Multicoin Capital, one of the largest crypto VCs as well, also lost half of its flagship fund's capital. Theirs wasn't actually locked. They lost it in terms of dollar amount due to the tokens that they had exposure to. Obviously, they were very heavy investors in the FTX ecosystem like Solana, and that's one of the main reasons why their funds dropped so significantly relative to other funds. So Multicoin did suffer huge losses as well. And then you've got other sad stories like Ikigai, which was a smaller niche $30 million VC fund having the majority of their assets in FTX, and they also went down. So many funds. And this is why I said the contagion can get worse, because we're now seeing widespread crypto funds, widespread crypto VCs starting to post losses. And this is only within the first week of FTX going down. This is before the bankruptcy proceedings. I think with the upcoming court filings that we're about to see, we're going to get revelations from a lot of other funds, a lot of other VCs that potentially things don't look so rosy over on their side. So the fact we already have like 6 or 7 already coming out and it's so early on in this process, that is concerning for me. And that's one of the reasons why I think it could definitely get worse. And on the flip side, many funds will come out and tell you they're okay, because we saw this many times with FTX, with Celsius, with Luna, with Voyager. They came out and they said, we're going to be fine, and there's nothing to worry about. Steady lads. And then what ended up happening, a lot of these protocols or lending platforms ended up collapsing. So I do think there will be more blood in this respect, because just as the 3AC collapse was the first domino for lenders like Genesis, I think the FTX bankruptcy will be the first domino for many funds who are now more vulnerable than ever. So all I think is in the future, it takes is a future black swan event to put the nail in the coffin. Number 4 is the lenders. Now, this is probably technically it's down on my top-down approach that we're taking a look at today. However, in terms of the pure amount of capital lost, the lenders have actually lost the most, more than the funds, because centralized lending platforms took the biggest hit from the 3AC and the FTX collapse. So if we actually look at the lending market, a lot of these major lenders were initially heavily impacted when 3AC collapsed. So what ended up happening for a lot of lenders, and this is what ended up happening for Genesis as well, is they were initially impacted by 3AC, but they were able to stay afloat. They were able to stay solvent, just by the skin of their teeth. They were just able to hang on. And then what's happened is, going into this FTX event, that's essentially been the final nail in the coffin for many of these lenders, because they were already on shaky ground for 3AC. That primed them for some instability. And then when FTX occurred, that was really that trigger for insolvency for some of these lenders. So what I think could potentially happen, if we look at the future effects of contagion here, is that similarly to what happened to Genesis and 3AC, could happen to lenders and centralized funds going forward into the future. And what I mean by that is this FTX event could be equivalent to 3AC and Genesis. So this FTX event, that could be the first thing that goes wrong for some lenders. For the next few months, everything could be fine. They can say that they've stabilized. And then in the future, there'll be another black swan event or another little event of instability or volatility in the market. And that will cause essentially the last straw for some of these lenders as well. So I do think there is a lagging effect whenever we get black swans, because that lagging effect means it may not kill a company straight away, but what it may do is provide enough instability to cause a downfall in the future. And that's exactly what we saw happen with Genesis, except on a retrospective basis. So starting with the 3AC collapse, because the lending market right now is very, very intertwined, because what happens basically with lending platforms is there's an extreme element of counterparty risk. As you have lenders that issue loans, then the people that are taking out those loans end up defaulting. In this case, it happened with FTX. Then other platforms take a loss because the original platform that lended out the money, now they don't have the money to pay back their original users. And essentially it's trickle-down effect, because you have lenders borrowing off lenders, borrowing off lenders. They can't pay them back. They can't pay them back, then they can't pay them back. And then eventually you have your final user, which is the one that ends up suffering, because they're the ones that have given their money to the lenders in the first place. And this is why we've seen the Voyager collapse, the BlockFi collapse, the Celsius collapse, now Genesis today as well, because of this element of counterparty risk. And I think now more than ever, people are starting to realize just how intertwined this market is. If it wasn't apparent before, it's extremely apparent now. This market is extremely intertwined. And that is why something like an FTX going down has such deep ramifications for the space, because they were very, very active in the space with giving credit facilities, for example, to BlockFi, where they gave them $250 million loan, but they gave it in their FTT token. So then essentially BlockFi now has a token that is almost worthless in value, which is an issue because now they ended up expected to file for bankruptcy. And as I mentioned, Genesis was similar as well. They had that initial strain when they lent out $2.4 billion to 3AC, and then were only able to reclaim 1.2, which already put a $1.2 billion dent on their balance sheet. And then FTX went under, and that was the final straw, because they had $175 million in locked funds in FTX. They had unprecedented withdrawals as people started panicking. And we know how psychology starts to kick in this market. Once a bank run starts, it's very, very, very hard to stop, because the rumors spread on Twitter, things get crazy. And the more people withdraw, the more you hear about it, the more you see the outflows spiking on the charts. And then that essentially is a self-fulfilling prophecy. And that's exactly what we saw happen with FTX. And also now what we've seen happen with Genesis and Gemini Earn as well, which is their affiliated Earn product, their more retail-based product. That also had to pause their service as well. So a lot of people ended up having their money stuck in Gemini Earn too. Now, Rand did talk about this earlier today, but there is kind of another shocking component of all this, and this is DCG, which is their holding company. They appear to be experiencing a liquidity crunch. Now, there's lots of rumors, and I don't want to come out and say something that's not true. So I'm just going to say right now that these just are rumors, but there is rumors going around that DCG is looking a little bit shaky. They obviously own the Grayscale Trust. That's already down massively. I think it's down like on a 45% premium based on Bitcoin's current value. They're also seeing at the same time, in tandem with GBDC, their Gemini or Genesis service breaking down, because they are the owners of Genesis as well. They also own CoinDesk, but I don't think CoinDesk is a highly, highly profitable business. I don't know the ins and outs of CoinDesk, but I wouldn't imagine it's as profitable as some of their other businesses. So it is looking a little bit shaky. Dylan Leclerc said it appears holding company DCG's liquid assets are below liabilities. And given how prominent these guys are in the space, if they were the next domino to fall, then that would be quite a bad sign for crypto in general. So I'm not saying they will. I'm just saying you got to keep an eye out on these things because there will be knock-on effects from Genesis. That may actually end up affecting Gemini. Gemini did come out and say that they still have one-for-one custody of assets, which is a good sign. However, we just don't really know until there's very, very transparent reporting when it comes to proof of reserves and liabilities. It's all really a guess because I guess a lot of our trust has been degraded in the centralized space. because of the lies we've been fed for quite some time. So we have to approach the market with an element of skepticism, maybe now more than ever than before. And then also another lender that went down was Salt. They were one of the very first lenders in the Bitcoin space. I think 2018 they launched. So one of the first lenders to offer DeFi services as well, and they had to pause withdrawals and deposits due to their exposure to FTX as well. So what this has done is it's kind of led me to ask the question, what does this mean for the future of CeFi? Because it really feels like, in my opinion, this is the end of centralized finance as we know it, because the business model has just proven at this point to have way too many points of failure. And I don't know, the CeFi model just doesn't seem sustainable to me. Whenever you're getting a 10% yield, which is more than the base yield you'd be getting on the blockchain, let's say Ethereum proof of stake is 5%, and you have services offering 10%, well, that just shows basically what they're doing is they're bridging that 5% gap with assuming more risk. And what I mean by assuming more risk, in most cases, is assuming more leverage. Leverage is addicting in this space, as we've seen with countless examples, and that's essentially how they bridge that gap between their base yield and the yield that they were actually offering. So we have to look at forms of sustainable yield now going forward. Obviously, DeFi is one of the obvious solutions to that. However, the CeFi market it does look to be extremely shaky right now. And then you've got the fifth factor, which I want to talk about, and that's the retail factor. And so going down from exchanges to lenders to funds to market makers and then down to retail is really where the true damage is done. And retail started all this, to be honest, because although there were mistakes made by Sam, which inevitably would have come up, I have no doubt that it would have come to a head at some point. It was the public sentiment that ended up triggering the initial downfall of FTX. And the exact same thing I think is going to happen as a response to the FTX collapse, because now they have thousands of users who have lost some, if not all, their funds on FTX. There's users that had their entire life savings on FTX, and there are now millions of investors, including likely yourself, who've experienced massive losses as a result of the systemic effects of FTX collapsing. Now, this has a huge hit on consumer sentiment, because we know consumer sentiment is one of the key drivers in crypto behind crypto asset price performance. So when you start seeing these massive dips, a lot of retail starts to lose confidence in the market. They start to lose confidence in the space. People that lost money in FTX start to become disillusioned with the space. Maybe a percentage or a large percentage of these people leave the space altogether. It's just a consumer sentiment disaster. And that is what I think above and beyond the FTX saga has done damage to. And I do think there is knock-on effects to that, because it's a demand-based business. And if there's no demand for the product, then the product can't appreciate in price. And now I'm not saying there's no demand. Of course, there's still a strong demand for crypto, but it certainly has hit consumer sentiment. And I don't think that is a fact we can be remiss of. So the FTX situation caused unprecedented damage to lenders, but the knock-on effects I think are occurring quicker in other sectors as well, and more fiercely than we've ever seen before. So I do have an interesting point to make now. So I'm seeing a few questions about this as well. I'm seeing a few people saying in the comments and on my Twitter, DeFi is the solution. Stuff CeFi, go DeFi, like DeFi is the future. Here's the thing with DeFi. Many DeFi protocols, as I alluded to before, they rely on Oracle data. They rely on liquidity from centralized exchanges. So if there's a lack of liquidity on exchanges, that does hurt DeFi. I think people are very quick to forget why we needed CeFi in the first place. So CeFi was needed in the first place because of its UI, because of its infrastructure, because of the liquidity it offered. And you could make many arguments that the CeFi products were vastly superior to their DeFi counterparts. I mean, have you ever used the Binance exchange or the BYBIT exchange and compare that to a DEX? It's a lot stronger. Maybe even if you say the UI on DEXs is better, you could make a strong argument that the platform interface as well as the liquidity is a lot stronger on the centralized exchanges. So the thing is, we kind of did need CeFi in the first place. Now, that's not me saying we needed crazy CeFi leverage lending. No, that was horrible, and that was what ended up causing this mess in the first place. But CeFi did offer, especially to institutional clients, that feeling of safety and security that maybe they didn't have in DeFi protocols, because of sometimes you don't know the teams, there's smart contract risk. Many institutions just aren't comfortable keeping their funds on chain, and that's why they needed centralized finance. And there's certainly a room for centralized finance because of that. Now, you also have to ask yourself the question, if you could trade thousands of pairs on DYDX or GMX with deep liquidity, then we probably would, right? But the reality is that up until this date, we haven't been able to do that. And that's because the tech isn't really ready yet. I mean, we're still so early in crypto that we don't really have the decentralized infrastructure or the tech to facilitate that kind of trading. And that's okay, because we're still probably years off a fully functional DeFi applications that can host both institutional and mass retail traders as well. So I do think DeFi is the solution, because if you do look at any of these events this year, all the negative events, they've been created by one thing, and that is human greed off the back of centralization. So I agree, decentralization is the future, and we have to move towards that future, but we also can't get too ahead of ourselves. We have to be aware that the technology is in its infancy at the same time, and just be aware that this is going to take time to play out, and it's not something that's going to happen overnight and instantly we're going to have all these amazing applications. These take time to build. Now, I do think we're making progress. I do think GNS and GMX are much better than the previous offerings we had last year, and I also think there's other great exchanges like BYBIT launched Apex as well, a decentralized exchange, which are all very good products, but we're still a little bit of a ways off to what CeFi could offer. But when I say CeFi in this respect, I'm more talking about exchanges and less so about lending platforms, because that was just stupidity. I'd much rather lend on a decentralized borrowing and lending platform. But certainly there has been a narrative shift. And we can see that through the outflows, that people are going away from centralized finance and onto decentralized finance. And that is going to create opportunities as the tech continues to develop. But I do think, as I said, the only way to move forward is to embrace what crypto was originally intended to do. And that is to be decentralized, be immutable, be permissionless, three things that these centralized entities weren't, and certainly three things that FTX wasn't as well. So that is kind of my take on some of the ramifications. I guess my summary would be, I don't think the contagion's over, and I think that's quite a logical conclusion to come to after you've kind of seen some of my analysis here today, because there are knock-on effects across all of the sectors we talk about, across exchanges, the market makers, the funds, the lenders, the retail clients. There's many different sectors which are going to be affected by this. However, it is also going to create opportunities. I just want to make that clear. It's not all doom and gloom, and there will be opportunities off the back of this. I'm going to be actively trading and looking for these opportunities. That's why I started my nested portfolio, so I can keep you guys updated with what projects I'm buying. So there's actually a link in the description to this if you want to check it out. And essentially what I'm doing is I'm going to be managing or running my own portfolio. We're actually still up despite the market being a couple % down, which is good because it means we're beating the market. I'm going to be running my portfolio, 3 portfolios, low risk, medium, high risk. I launched the low risk today. I'll be launching the medium and the high risk soon. And just to be kind of clear here, before you ape into this portfolio, these portfolios are intended for, let's say you want to start DCAing into assets, and you definitely want to increase your exposure to the crypto market, then you could look at this portfolio as an alternative, provided that you have stablecoins on the side. So it's not my job to keep stablecoins for you. You have to make sure you have an adequate amount of stables on the side, and then you do have the option of DCAing into a portfolio like this one. And as I said, we're going to be creating more in the future. So just as a promotion, because we're just launching this, we're going to be giving away $1,000 to 2 people that copy the portfolio. So there's a link in the description to copy it. It's pretty simple, actually. All you need to do is click deposit funds, click simple deposit, either select a stable coin or a cryptocurrency. Let's say I want to do USDT, or you can even add funds straight from your Visa or your MasterCard to on-ramp straight to DeFi. So that means you can bypass CeFi and on-ramp straight to Nested. Nested, by the way, just because I've been getting a few safety questions based like, is this safe? Is this a safe place to DCA? I can confirm that all of their assets are held in custody and they're held with insurance. So they have insurance backing for your assets. So your assets are safe. You're not going to get rugged. So they're in custody and they're safe under an insurance regime. So yeah, essentially you can just deposit and copy the portfolio. But as I said, I'll be doing more updates on this portfolio as time goes on. But I just thought I'd introduce it to you guys today and also announce the giveaway. We'll be going to some of the early adopters of the portfolio. But that's going to be one that I actively trade because I don't really look, DCAing in this market, certainly a valid approach for some people. But at the same time, I'm always on the lookout for new opportunities. And my goal really is, and the goal of my team as well that work with me on research is our goal is to outperform the market. At the end of the day, if we can't outperform Bitcoin, what are we doing as full-time crypto participants? So my goal right now is to try and outperform the market, and hopefully I could showcase for you live with this spot trading. Unfortunately, it means we can't take advantage of shorting, but if we can outperform Bitcoin's price, then I guess we're winning. So yeah, I was just going to look at some of the comments here for a second. We don't need CeFi, buddy. Stop the nonsense. We do need CeFi until DeFi is fully up and running. I agree we don't need CeFi lending. I think it's stupid. I think you're just taking on unnecessary risk in the form of leverage. However, I do think that until DeFi is ready to host the amount of users that we think it can host, then we do need centralized exchanges. Of course, we need centralized exchanges. That's where you get your on-ramps. That's where hopefully they end up working positively with regulators in the future to help get more institutions into crypto. I mean, at the end of the day, institutions feel more comfortable with these type of platforms if they have proof of reserves, if they have proof of liabilities, and if they're transparent. I actually think the gold standard right now for transparency in crypto is probably Coinbase, because they're a listed company. So by and large, they have to be transparent, unless they're conducting some major kind of fraud. They're going to be transparent, right? Because they have to be. So I probably think they are they're the safest ones at the moment in terms of. I mean, obviously Binance is very safe, but they're the ones that have been the most transparent, is what I meant to say. MetaMate said, "Hi Miles, great take on Real Vision. Hope you guys enjoyed that. I did go on Real Vision today. Lots of damage to retail. Going to take ages to recover from." Yeah, it will. It's going to take a while to recover from. Although there is the alternate argument that I'm toying with in my head. And that argument is that this was going to happen inevitably. The house of cards couldn't keep stacking forever. It was inevitably going to fall down. And I would rather have it happen sooner and give us more time to implement the adequate regulation that we need to implement than it happen later when crypto's too big and we end up having a scenario where even more trust is lost in this market. So we're almost lucky that, I mean, look, I don't want to say we're lucky because obviously it fucking sucks. But if we do want to look on the bright side, we are lucky in the respect that it's happening sooner rather than later. By definition, CeFi is not trustless, permissionless, decentralized. No, it's not. But that's not the only prerequisite for, somewhere we can trade. I copied your Nesta portfolio. Yeah, I hope we can make some money for you guys. At the end of the day, that's my goal, to make money on this portfolio, or at the very least, outperform the market. Because if you guys are going to DCA anyway, then I hope you can DCA into a portfolio that can help you outperform the market. But always make sure you keep stables on the side, because my job isn't to be a hedge fund and keep stables for you. You got to keep stables, and you only got to DCA when you want to DCA, and hopefully Nesta gives you an option to do that. So this will definitely take time. Yep. I think that's young man spitting old man knowledge. Appreciate it. Digging the new sophisticated look. Thank you. Yeah, I've started wearing the shirts on the show. I don't know why. I just feel like more. I don't know. I feel like I'm more adept. I can kind of think a bit clearer. I don't know. It's very much a mental thing. This is still the Lunar Fallout. 100% spot on. I actually have a pretty big take on this, and I'll kind of give you maybe a little bonus take now on why I think Luna was one of the reasons that FTX collapsed. This is one of the theories floating around. Of course, there's many theories. There's even theories that FTX caused the Luna collapse. But the way I kind of see it is, I just wanted to get my notes here if I actually have my notes, that earlier in the year, Alameda took out loans to make venture capital investments and various other expenses. We know some of these other expenses were Sam Bankman-Fried's personal loans, for example, houses in the Bahamas, all sorts of stupid crap, but they did take out loans to make investments. And what happened was Luna ended up collapsing. So lenders moved to recall these loans. FTX was quite illiquid at the time because they were holding mostly FTT tokens and other tokens that weren't fully vested yet. So although their balance sheet, let's say, said $14 billion, only, let's say, $5 billion of that $14 billion was accessible. And when you're illiquid like that, you kind of have to make a choice of where you get your funds from to pay back loans and to fund new investments. What they clearly chose was using consumer funds. That's the wrong decision, of course. It's a horrible decision, but I feel like they used consumer funds to make those payments. And then I think Sam got a little bit aggressive, started gambling, started going too aggressive, trying to make his capital back, making more aggressive investments, putting up his own assets as collateral to lend against it, to get more like fake liquidity, to make more investments. And it kind of just went a little bit far. That's one of the rumors. That's one of the theories that the lunar collapse triggered all this. But of course, that may be wrong. I think it's plausible to some extent, but I do think the rabbit hole goes a lot deeper than just that basic theory. You also have the theory that Alameda took a large leverage position on FTX. That position went negative. Then FTX should have liquidated them, but didn't, because FTX had a clause which is that they wouldn't liquidate Alameda assets. So the negative P&L grew and grew and grew. And then as the market collapsed, of course, when CZ did that tweet and there was all that FUD that started coming out, FTX was left with a huge amount of bad debt. And the bank run that ended up happening revealed that debt hole. That's another little theory. So a couple of theories for you guys to end the show, but I'm sure we're going to get a lot more clarity over the coming weeks and the coming months as the court proceedings do continue. All right, I'm going to head off. I am heading to Amsterdam tomorrow. I'm still in London. So I need to get packing, need to get ready. And actually, we are going to be on Spaces for 6 hours tomorrow. I know it's crazy. So I think tomorrow at, let me get the exact time, 5 a.m. EST until 11 a.m. EST. So we'll be on from 10 a.m. London time to like 4 p.m. London time. So tomorrow during the day or the morning, if you're in the US, we're going to be on Spaces. So come hang out, join. We've got some massive guests. We're going to be talking about all the FTX stuff, the contagion. We've got some insiders that are speaking, some of the biggest guys in the space coming on to join us for a very, very big Spaces tomorrow. So if you want to hang out and talk to me on Spaces tomorrow, that is where you can catch us. It's going to be a 6-hour stream. It's going to be crazy. I don't even know how I'm going to do it. It's so long, but you guys can just join in for 10, 20 minutes. If you just have a spare moment tomorrow, just come onto Twitter, check it out. And yeah. All right, guys, hope you enjoyed the show. I am going to get on with the rest of my night. It's getting very late. And until then, I will see you tomorrow. Peace out.